Welcome to this explainer. If you're the kind of person who loves looking past the flashy marketing to dig deep into the actual gears of a business, well, you are absolutely in the right place. Today, we're conducting a deeply analytical, completely objective, forensic teardown of the red herring prospectus for the upcoming Advit Jewels Limited IPO. We are going to strip away all the noise and use the raw data to understand exactly what this company does, where their cash flows from, and what they actually plan to do with your potential investment. But before we really get into the weeds, we need to establish a critical foundation. This video is purely for educational purposes and does not constitute financial advice. We are literally just here to look at the facts and figures objectively. Please always consult a SEBI-registered advisor before investing. Okay, let's dive into this. We have a lot of dense financial data to unpack today. Our roadmap covers the business and revenue model, objects of the issue, financial health and metrics, key risks and red flags, valuations and peer comparison, and we'll wrap it up with a summary and final thoughts. Let's get right to it. All right, section 1, the business and revenue model. Basically, we need to understand the engine of this company and what they actually do on a day-to-day basis. So, Advit Jewels operates under the brand name Ramba Hall. What they do is manufacture 100% handmade Kundan Polki jewelry. This is highly intricate, traditional work using real gold and uncut diamonds. Now, instead of spreading out all over the place, they've actually centralized their entire production process, literally from melting the gold to the final stone setting and polishing, all under one roof in a 6,450 square foot leased facility in Jaipur. By keeping the whole shebang in-house, they maintain incredibly strict quality control. Plus, it drastically reduces the movement of precious materials, which naturally cuts down on transit risks and those hefty insurance premiums. It's a major factor in how they manage their costs and protect their margins. Now, when most of us think of jewelry, we picture a fancy retail showroom. But what's really interesting about this revenue breakdown for the period ending December 2025 is that it reveals a totally different story. A massive 82.41% of their revenue comes from the business-to-business or B2B segment. They are primarily supplying national retailers, regional showrooms, and family jewelers, rather than selling direct to the consumer, which only makes up about 17% of their pie. Essentially, they're the wholesaler standing right behind the retailer. Moving on to Section 2, Objects of the Issue, or in plain English, where exactly is the money going? Whenever a company raises public capital, they are legally required to declare their exact intentions. To really grasp an IPO, we got to clarify two crucial terms: fresh issue and offer for sale, commonly known as OFS. A fresh issue means the company is creating brand new shares, and the money you pay goes directly into the company's bank account to fund its operations. An offer for sale, on the other hand, means existing early investors or promoters are just selling their personal shares to you, and that money goes straight into their pockets as they cash out. And here is where it gets interesting for Advit. The prospectus clearly shows that this is 100% a fresh issue of up to 1,19,68,000 equity shares. There is absolutely zero offer for sale. This means the promoters, the Gilara family, are not cashing out a single share in this IPO. Every single rupee raised, minus the standard issue expenses of course, is going directly into the company itself. So the crucial point here is what they're actually doing with that capital. They've earmarked exactly 6,500 lakhs directly for funding incremental working capital requirements. Think about it. Because their B2B wholesale model requires them to hold a ton of high-value raw materials, like gold and diamonds, and manage massive inventories, they need substantial cash on hand simply to operate and scale. They aren't using these newly raised funds to pay down existing debt. This capital injection is purely designed to grease those everyday operational wheels. All right, let's look at the numbers. Section 3, Financial Health and Metrics. Time to put their 3-year track record right under the microscope. Wow, okay, so the top line growth here is super visible. They jumped from just over 4,600 lakhs in FY 2023 to nearly 12,500 lakhs in FY 2025. That is a massive 79.91% revenue growth jump in FY 25 alone. The bottom line profit after tax totally followed suit, growing consistently from 1,038 lakhs to over 2,500 lakhs in that exact same 3-year period. However, as a smart investor, you must also check their cash flow from operating activities to ensure these aren't just pauper profits tied up in uncollected receivables, and you definitely want to review their current debt-to-equity ratio to see exactly how leveraged this recent growth actually is. So, what's the secret sauce behind that profitability? It really comes down to these specific margins. In FY25, their gross profit margin was 32.89%, and their EBITDA margin, which is a great measure of operational efficiency, stood at a very robust 29.73%. On top of that, their return on net worth was 43.64%. These metrics clearly show that their centralized manufacturing facility in Jaipur, combined with that heavy B2B focus we talked about, is currently allowing them to scale operations while keeping a really tight leash on their costs. Which brings us to Section 4, Key Risks and Red Flags. Because, hey, numbers in a vacuum only tell half the story, right? Let's explore the structural vulnerabilities. Every single business has risks, and the RHGP spells Advit's out clear as day. First off, because they are so heavily B2B, they pull a substantial amount of revenue from a very limited number of clients. If they lose a major wholesale customer, that is going to hurt for sure. Second, any shift in their sales mix is a big risk. If they try to expand their retail B2C presence too fast, it could require massive inventory investments and drastically lengthen their cash conversion cycles, straining their liquidity. They are heavily reliant on an inventory-heavy wholesale model right now, and that requires constant, significant financing just to stay afloat. Also, it's absolutely crucial to comb through the prospectus for any pending litigations or tax demands against the promoters, because those contingent liabilities can totally blindside future profitability. Okay, Section 5, Valuations and Peer Comparison. Let's see how these numbers actually stack up against the broader market. This table brilliantly illustrates the difference between top-line vanity and bottom-line reality. Consider a giant in the space like Bluestone. They generated a staggering 17,700 lakhs in revenue. But look at this. They posted a negative PAT, a loss of over 21,000 lakhs, with a super thin EBITDA margin of just 4.29%. Meanwhile, Advit, with a mere fraction of the revenue at 12,493 lakhs, is rocking a 29.73% EBITDA margin and a positive PAT of over 2,500 lakhs. They are a much smaller ship, but currently a significantly tighter and more profitable one compared to some of these larger peers. But remember, to truly compare value, you've got to evaluate Advit's proposed PE ratio at the upper price band against these peers to see if it's priced at a premium or a discount based on their actual earnings per share. And that brings us to Section 6, Summary and Final Thoughts. Let's pull all these threads together and recap the fundamental profile we've just uncovered. Objectively speaking, here is the raw data takeaway. Advit Jewels is a highly concentrated B2B manufacturer with over 82% of their revenue coming straight from wholesale. This IPO is a 100% fresh issue, meaning the promoters are keeping their skin in the game for now with no exit. They've demonstrated really strong historical growth, highlighted by a nearly 80% revenue jump in FY25, all supported by solid margins. And lastly, the primary reason they're asking for this public money is simply to fund the heavy working capital requirements that naturally come with holding massive amounts of gold and diamond inventory. So what does this all mean for you? Well, that leads us to the ultimate question. Advit has clearly proven they can generate high margins as a B2B wholesaler, but are you comfortable funding the massive inventory required to keep that engine running? The numbers are out there, the risks are heavily documented, and how they align with your own personal risk appetite is entirely up to you. Thank you so much for joining me for this explainer. Keep doing your own rigorous due diligence, and I'll see you on the next deep dive.